There's the closing bell on Wall Street, and now it's market domination overtime. Jared Blickery going to be along in a moment to get us up to speed on the action from today. I'm going to give you the closing numbers here. Dow just peeking into the green, very barely, about 36 points by the end of the session after being red for most of the day. The S&P 500 finishing higher by about 0.4%, and the Nasdaq Composite up about 0.2%. So a lot of weighing today of the continuing trade headlines. As we know, China and the U.S. continuing to sort of trade negative language, let us say, against one another, each accusing the other of violating their sort of tentative trade détente and agreement here. But we did learn there has been some reporting that Trump and Xi would be having a call this week. That it looks like it's being planned, so that perhaps giving a little bit more optimism to the market. By the way, in the background, we got a manufacturing number this morning that showed contraction for the second month in a row. So that's something also that investors have been considering. Let's see what Jared Blickery has been considering. Hey, Jared.
Yeah, that's a great, I guess, detail of the fundamental macro backdrop. I was just looking at a 1 month chart, and here's a technical backdrop. 15 sessions, exactly 3 trading weeks, and we have gone essentially nowhere. That is just sideways. That's the Nasdaq. Broke up a little bit after those NVIDIA earnings, but here's the S&P 500, just nothing but sideways right here. So we're just looking for the next catalyst, and with all the trade tariff headlines and all the data that we've gotten, we still haven't seen that in 3 weeks. So I'll be sitting on my hands waiting for that next one. Here's the VIX. It was, it looks like it was up just a little bit today, still holding under 20. So nothing major there. 10-week T-note yield up about 5 basis points, not quite to 4.5%. And the 30-year, guess what? That was up 7 basis points to 5%. That's the magic number that was causing some hiccups in the equities markets and the risk markets a couple weeks ago. We'll have to see if that causes any more disruption here. Also, the U.S. dollar index very close to year-to-date lows. This is just a 1 month chart, and I got to move on here, but that would also be a near 3-year low. So something interesting there, and we're seeing commodities rally quite a bit. I'll be getting into that with Josh in about 30 minutes or so. For the time being, energy is up 1.3% on the back of WTI crude oil having its best day in weeks. Tech is second, that's XLK. Then you got materials and communication services. Rounding out the top 4, all of those outperforming the S&P 500. And let's take a peek inside the NASDAQ 100, where Meta is a standout right down there, 3.62%, and also Alphabet and Tesla. So Alphabet down 1.58%, that's Cisco, but Alphabet down 1.58%, and then we got Tesla down 1%. I'll leave us on the Dow here, and we got a little bit of a mixed board, but much better than when we started out the day. On the opening bell, I was looking at a lot of red towards that right-hand side of the screen, and a little bit more green now into the close, after the close. Back to you, Josh.
Thank you, Jared. We're joined now by Travis Spence, the global head of ETFs at JP Morgan Asset Management. JP Morgan Asset Management has whopping $3.7 trillion in assets under management, with about $190 billion in ETF assets. Travis, thank you for being here.
Josh, thank you for having me.
Start off here, Travis. You say 2025 is going to be the year of active ETFs. Walk us through that, Travis. Why is that? In part, is that because we find ourselves in this backdrop here where we, as investors, we've just got so many questions and there's just so many uncertainties?
Well, look, there's certainly more uncertainties in the market, but if you just look at kind of where this industry has come from and where we think it's going, I think that gives a little bit of the answer. So active ETFs now is a 1.3 trillion industry globally. Didn't really exist 10 years ago. So that's been growing really fast over the last 10 years. This year, if you just look at flows, let's start there. It represents, 1.3 trillion represents about 8% of the global ETF industry, about 15 trillion. But this year it's brought in about 30% of net flows globally. Here in the US, it's even higher. It's about 40% of net flows have gone into active ETFs. So flows is one indicator. Issuance is the second indicator. In the last 3 years, the total number of active ETFs has doubled. There's been more active ETFs launched than passive ETFs since 2020. That's happened every single year. This year, 80% of all ETFs issued in the US were active. In Europe, it's about 40%. That's come a long way. So we're seeing most of that issuance go into these like traditional core sectors. Think your large cap equities, your core bonds. That's where a lot of the ETF growth is, active ETF growth is coming from now. And so that's going to be a big determinant of future success as well. So as a lot of these ETFs that haven't quite hit 3 years, haven't quite gotten to scale, start to scale up and more investors start to use them, that's where you're going to see a lot more growth coming in the future years. And then the third reason is where you started, which is, we're in a market which has lots of uncertainty. The market doesn't like uncertainty, but this is where traditionally we found at JP Morgan Asset Management that we have some of the best years in terms of active outperformance. So it's these kind of years, like think about when you're in a plane and you get turbulence. I want somebody driving the plane. I want them flying the plane through
Stock
that
and bond
turbulence.
picking.
Yeah.
Absolutely.
I mean, what's so interesting, though, is that the ETFization of the U.S., in particular investing landscape, has been driven by passive, right? And it was because why not just index against the S&P 500, for example? Because over time, if I start investing in it at the beginning of my career and I take it out at the end, I've probably done pretty well, right? And I've done it at a lower fee than in the traditional funds. So I guess the real question is, does active outperform on a consistent enough basis? Are people just throwing it in there with that hope, or we actually see it happen?
Yeah, look, we could talk about what we do. That's the perspective that I can offer. We're a traditional active asset manager, and as you said at the beginning, we're running 3.7 trillion in assets. Our DNA is active. We want to be bottom-up stock picking. We want to take the 370 analysts that we have and make sure that they're finding the best opportunities for us across any portfolio, equities or fixed income. That's what we've brought into our active ETF range. We launched our first active ETF back in 2017. So we've been early into this space, and our experience has been really positive, where we're delivering some of what we've done traditionally best in our active strategies, and we're delivering that now also in the ETF wrapper. So clients have access into the ETFs, into those active ETFs, and those same portfolio managers, the same research analysts that have been producing, not just over the last 5 years, but over the last 10, 20, 30 years in proven track records, and that's what they get access to in the ETFs. For us, that's what active ETFs mean.
I'm curious, Trevor, when you talked about those flows into active ETFs, what's that coming at the expense of? Is that, what are investors less excited about?
Well, I think you've seen a secular trend over the last, kind of 10 years of movement from the mutual fund wrapper into the ETF wrapper. So we've seen that here in the US, and that's a part of it. I think we also see a lot of clients moving from just passive strategies. Now that you have active ETFs available, again, in some of these core sectors, think of your core bond sectors, your large cap growth sectors. Now you have a real option that gives you some additional benefits by being in the ETF wrapper: the transparency, the price discovery, the ability to trade every day, and in many cases, a much more tax-efficient wrapper.
So put all this together, what should people be doing right now? Which ETFs should they be looking at in this environment?
So I think there's two recommendations that we would have. Like in this environment where we've got rates and spreads moving around, we've got the tariff impact, which is really at a company-specific level. That's not even an industry-specific. It's what companies are doing with their own supply chain, and that's something we need to evaluate from a fundamental basis. So I think two things is really, one, get active in your core portfolio. Activate your core. We always say when we're going to the gym. So I think that's number one, and you can take advantage of these active ETFs now in those core sectors. So think of your intermediate or your core plus bonds, your income strategies in fixed income. We've got some great options within that, things like J-Bond, J-Pie, that have been doing really well in that active ETF wrapper. The second, and then of course in equities as well, you've got your growth strategies, your value strategies that are now in active ETFs. The second recommendation we would have, and this is really important in this environment and where we've seen most of the flows in the active ETF space in the US this year, has been into strategies that are more downside protected and into ultra short bonds. So that's where we've seen the bulk of the assets go. Those are things in innovations that came out in the ETF wrapper, like derivative income. So JEPQ that we offer, which provide a bit more downside protection with an option call writing strategy that also provides income by staying invested in the equity market. With that extra volatility comes a little bit of additional income that we can get through those derivative overlay strategies. So JEPI and JEPQ that are representing what you would get normally within a broad core equity exposure or within the NASDAQ exposure are now offering yields of 11, 15% in addition to being invested in the market with a bit of downside protection. Those are ways to, again, stay invested and get invested if you're not there already.
And Travis, we mentioned at the top, you all have about roughly $200 billion in ETF assets. You do have some big name rivals. Just when you look at the competitive landscape, what do you think you all do different?
I think it's, again, our DNA is being a core active manager, and we've approached this market by thinking about those things that we've done really, really well that we can now make available in the ETF wrapper. And so bringing the best of our capabilities into this space, that for us has been really successful. The other side is being an innovator in this space. We were very early, even with something like an ultra short core bond portfolio, which is JPST, which was launched in 2017. That's now become really it is the largest active fixed income ETF. But that has provided access to investors that really want to hold some strategic cash in their portfolio, but still get a reasonably good rate of return. Today, that's about 4.5%. So that's pretty good for just being invested in a safe, secure, and core fixed income asset class. But then the innovation around things like JEPI and JEPQ, where it was that combination of something that, as an outcome, income really was the outcome, but it's putting together a long portfolio of equities, staying invested in the market, but getting that extra income. That was an innovation and that was made available to a much wider range of investors in the ETF wrapper. That's been really successful. So I think ETFs can provide that unique access into the market.
Travis, great to see you, especially on set. Thanks for your time today.
Thank you.
Time now for What to Watch Tuesday, June 3rd. Starting off with earnings, Dollar General and Signet Jewelers set to report first quarter results. That'll be before the markets open. Analysts looking at Dollar General for more color on the state of the consumer as tariffs cast a cloud of uncertainty on inflation. After the market closed, then we got CrowdStrike and Hewlett-Packard Enterprise gearing up to report their first quarter earnings.
CrowdStrike's latest results will come following a disappointing earnings outlook in March. The cybersecurity company in a state of recovery after its flawed software update last year that caused Windows computer systems to crash globally. Turning to the economy, Wall Street can expect the latest data on job openings for the month of April. Economists expect a slight decrease to 7.1 million openings compared to the 7.2 million in March.
And lastly, investors will hear commentary from several Fed officials. Fed Governor Lisa Cook, Chicago Fed President Austin Goolsbee, and Dallas Fed President Lori Logan all expected to speak on Tuesday. This is coming as a divide is emerging within the Federal Reserve about the path forward for interest rates.
Coming up, all eyes on Starz as it bets big on its original productions. We're talking with the company's CEO on the other side. Stick around, more market domination over time still to come. Fresh off its separation from Lionsgate, Starz Entertainment is betting on itself as well as the growth of the streaming landscape. Joining me now to discuss the path ahead, Jeffrey Hirsch, Starz CEO and president, as well as Yahoo Finance's Ali Canal, who focuses on media and streaming for that matter. Jeff, thanks so much for being here.
Thanks for having me this afternoon.
So you guys spun off from Lionsgate, Starz as an independent entity. And so since we have you here, let's get you first of all to just say what that is, right? How should investors be thinking about Starz as independent from Lionsgate, and kind of what are you trying to achieve as an independent company?
It's a great question. I think we're a very investable business. If you think about just going through the kind of statistics of the business, we do $1.4 billion in revenue. 70% of that revenue is already digital, so we look more like Netflix than we do look like an AMCX. We generate about $200 million in profit, so about a 15% profit margin. So as we've transitioned the business from linear to digital over the last 7 years, we've always been profitable. And we'll convert about 70% of that $200 million to unlevered free cash flow. So we throw off a lot of free cash flow too. So it's a very healthy business, and we just came off of our business update last week. We grew the OTT subscriber base 530,000 in the U.S., and we grew the entire U.S. business almost 2%. And so business is strong, and it really starts with our content, right? We have some great big shows. Outlander prequel coming. BMF is premiering this weekend.
Outlander prequel.
Yeah, it's going to be a great show for the fan base that we can talk about. But we have a great string of shows over the next 12 to 16 months that'll really drive the business. So we're really excited about being a separate standalone business where we can focus on what we do well.
And you said before that Starz is a misunderstood asset. What do you think is the most underestimated part of your business?
I think people look at the space today and say, if you don't have scale, you can't survive. And they say, in the land of giants, how could little start? And I actually think that's a strength for us, because with disruption comes the ability to have to pivot and really kind of focus on certain areas quickly. And we've been able to pivot faster than anybody to the digital landscape. And so when I started at Starz in 2015, 100% of our revenue came from the linear business. And we were kind of a cable add-on, a lot of bundling and packaging. And today, 70% of our revenue is streaming. And so we've been able to make that transition. And I think as these large companies try to move and they kind of feel like oil tankers where they take a long time to move, we've been able to move very quickly to take advantage of the disruption in the business.
When people think about the streaming services and digital services, they think about Netflix, I guess, as sort of everything. Disney is sort of family. Like, how should people think about the Starz identity, the niche that you guys are serving?
Well, we really focus on women and underrepresented audiences, and women are 49.6% of the planet. So if that's niche, I'm pretty happy that we have that as a thing. But when we launched our app in April of 2016, the data showed women were driving our business, and so we made a conscious decision to lean in and really solely focus on adult scripted content for women and underrepresented audiences. And today, 2/3 of our subscriber bases, which is around 20 million, are women. And half white women, half black women.
Well, and I would say not just, you say adult content, like it's kind of sexy, some of the shows, right? It's not something that you're going to sit around with little kids and watch. It's for a more sort of sophisticated eye, if you will.
Yeah, we don't try to be all things to everybody in the home. We don't try to serve everybody in the home. We don't have Bluey on for the dogs and, different content. And so it's really, our brand tagline is we're all adults here. Right, so it's just specifically for adults. And what we find with this customer base is, at the end of the day, when they've done their work and taken care of their family, they like to escape with our content because it's their hour to be by themselves. And we think that's a really great place to be in a very competitive landscape today.
We saw the news earlier today that Byron Allen is putting up his broadcast TV stations for sale. We know Comcast, Warner Brothers Discovery, they've positioned potentially their businesses to spin off those cable units. You said before that M&A could help improve your revenue picture. Are you still a buyer? Would you consider yourself a buyer of those linear assets? And what's attractive to you out there right now?
Look, I'm not going to speculate about M&A. What I would say is that we have two very, very, very valuable demos in women and underrepresented audiences, 20 million subscribers with an opportunity for another 80 million total. We have a tech platform that we built ourselves that we can scale, and so it looks a lot like the BAMTech business was that Disney bought years ago. So it's a very valuable business. Now, what that tech platform allows us to do is help some of our linear peers that have been marooned on the linear side by actually giving them a digital product and launching them into the digital world. And so whether that's through commercial arrangements or potential tie-ups between the companies, I think there's an opportunity there. But on the other side, I think what we built is very valuable to anybody who's looking to scale themselves.
Well, let me ask you this then. As someone in this industry, we've seen media deal making kind of take a backseat over the past several years. What will it take for that to pick up again? Is it lower interest rates? Is it more clarity around the tariff picture? What are you watching as sort of an executive here?
Look, we're always watching the tariff situation. Interest rates, obviously, there's a lot of talk about that today and last week, and that's always helpful in a lower interest rate environment. I think DC, obviously, what's going on with the FCC and the SEC right now is really important to watch. Yeah. I do think once folks figure out what I'm seeing right now in this space is a lot of folks are inward looking and trying to figure out who they are and what they do well. And once they figure that out, then I think they'll shed assets before they actually try to combine. And so there'll be a great shedding first, and then there'll be a reconnecting of other things. So I think it'll take, I don't think anything will happen for the next 12 to 18 months, but I think after that you'll start to see people reconfigure their businesses.
And as you mentioned, it sounds like that you are focused not on that rolling up, but more on organic growth and maybe adding services to other networks with commercial arrangements. But then you also mentioned maybe you would be a good acquisition candidate, if I read that correctly, down the road, maybe when that door opens back up to more M&A activity?
Look, again, if you have a very valuable, profitable business that throws off a lot of cash, that has a unique tech platform that others don't, of course it makes you interesting to others. I do think there's an opportunity for us to build around the demos that we have and get to scale and build kind of a scaled media business focused on women and underrepresented audiences. But, again, right now, 4 weeks from separation, we're really focused on, just driving the core business and delivering on the guide that we gave to the street last week.
Yeah. We were talking a little bit about this during the break, but how has it been going from You were with Lionsgate, now you're separated, you're in the stock market right now. How has that changed your job and your outlook for this company?
It's been a very quick and interesting change. I think John and Michael should get a lot of credit for being, the first to separate the businesses into kind of streaming and studio business, and you see everybody else thinking about that now. My job has really changed to be, have a board now that I didn't have before, and I have investors and shareholders, and so that's a lot of part of my job, and that's become different. I've been an operator most of my life, and so having to depend on a wonderful team to run the business while I'm out doing things like this has been different for me, but I've enjoyed it.
And so far, the stock has been trending higher.
Yeah, it's been a nice start. Yeah, look, I think ultimately, you look at the two stocks of the two companies and how they've run up since the separation. I think it's proved out that John and Michael on the board, the separation of the assets to put value in the right places has come true. So I think it's been a great decision for everybody.
Jeff, thanks for coming in.
Thanks for having me. It's great to see you
Good to
both.
see you, Allie. Thank you as well. And that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow, 3 p.m. Eastern, for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's Asking for a Trend. Josh will be back. He's got you covered for the next half hour with the latest and greatest market-moving stories, so you can get ahead of the themes affecting your money. Stay tuned.